So where have we been? We've been calmly watching markets move higher. So we have a bull and a bear, another new high, another new high, another new high, another new high. You guys have that experience from last year? It just didn't end. There were, how many were there? There were 64 new highs in the S&P, 70 new highs in the Dow Jones Industrial Average last year. That's the second ever. So which year was the first ever?
Sometime in during the Clinton administration?
2000, I got a 2000 guess.
1996.
1995. There were 72 new highs in 1995. So why is that important to us? The idea that we get a lot of new highs and that means it's going to come down right away, it doesn't hold water. So in 1995, there were 72 new highs, and it was 5 years until it came down. Okay? It did come down, it came down quite hard, but first it went up 100%, then it came down 50. Right? So timing these kind of things based on what's recently happened is very difficult to do. I don't even try. And this is kind of the last year. So I am really excited about this. Why? You guys have been here, those of you who have been here for the last couple times, why am I excited about this? Come on. See, this is why this takes longer than 45 minutes every time. It's interactive. So I'm excited because of this right here. So do you remember the last 2 years, we've talked about pairing it out of the S&P and putting it towards emerging markets and towards international? 3 years, slowly building a position in emerging markets, slowly building a position in international markets. Because the S&P was kind of rich, it was kind of higher value, and the other things are kind of undervalued, and eventually those things revert. That's called just basic reversion to the mean, right? So eventually that happens, and it repeats, and it happens again and again and again. And this didn't happen for 6 years. We slowly added more money to emerging markets and added more money to international for 6 years. Meanwhile, not this group that comes, but the other group that calls up and says, why do we have so much international? It's just dragging us down. Well, this is why. You never know when the turn comes. You never know. But we were there when the turn came, and we had an allocation. Everyone else, I talked to all my peers, how much do they have in emerging markets out of their equities? Sub 5%. How much do we have? Over 13%. So we experienced very good times. Not because I'm smart at all. Because I'm dedicated and committed to diversification. Okay? It doesn't go away when we're wrong. It doesn't go away when we're right. I don't toot my horn when we're right. I don't complain when we're wrong. I explain and then I explain. That's how we do it. So this was a great turn for us. What happens next year? No idea. No idea. That emerging markets is lots of stuff built in here. Obviously Russia, EM Europe and EM Eastern Europe were the drags on the emerging markets. Everywhere else did really, really well. We don't care. Like, we are very, very broadly diversified across the emerging markets. It's nice to see this, and that means there's still opportunity. Okay. In the US, how many times have you heard me say earnings drive stock prices? All the time. Earnings drive stock prices. Earnings drive stock prices. The expectation of earnings drives stock prices. If we're going to explain what's going on right now, first, earnings are off the charts good. Earnings are incredible. We'll talk about why in just a minute, but earnings are really positive. Second, they're accelerating. They're not decelerating, they're accelerating. That's partially due to a 20% tax rate, 21% tax rate. That'll cause other issues, but in terms of the economic factors, the earnings factors for companies, it's going to increase earnings even further. So earnings are accelerating. That's a huge positive. And the expectation of earnings accelerating is why we see a lot of the upside that we've seen in the last 6 months. So these are the different sectors. This is last year in these different sectors. This is energy. Does anyone remember what happened in 2016 with energy? Yeah. Fell out of bed entirely. Like, all the oil stocks and all the oil patch had a really, really tough time. So this, while it looks great, is really just recovery, right? So this, notice how that's the best performing in terms of earnings growth, but let's look at stock price. That's the green one that's hiding behind the blue one right there. So I apologize for how busy this is. This is all the performance of the individual sectors. So earnings growth doesn't necessarily mean, because there's a bigger picture, like where'd that earnings come from the year prior? Okay. So this was another thing we talked about in our guiding principles letter in January. So before 2017, there were 10 times in the history of the VIX where it closed under 10, total.
What is the VIX?
The VIX is a measure of how volatile investors expect the S&P 500 to be over the short term. Higher VIX, people are expecting higher volatility, meaning zigs and zags. Lower VIX, people are expecting lower volatility. So when it closes at such a low level, for almost, look at this, once it hit July, it spent half a month between July and August, half a month in September, October, lots of different days here. It started the year, the average from 2004 till today is about 16 and a half. It only went to that level once in the whole year. So it was a very low volatility year. So we have increasing earnings, we have low volatility. Okay, so volatility, this is an anomaly how low this is. Okay, maybe it's not broken, but something that we shouldn't expect again. So this is the reality, and there's a lot of people that say that this is suggestive of a bad indicator. I'm just putting up there for a reality. Okay, so historical average is about 38%. Is that 38? Yeah, 38.5. We're bullish 52.5%. So there's a lot of extra bullishness out there. A lot of extra bullishness. And average is 30.5, we're at 20.6, a lot less pessimism. So this is going to boost stock prices. That emotion boosts stock prices. However, the flip side of that is, once we've all got our money in stocks, if we're that bullish, who else is going to put money in there? Right? It's an interesting question because we've also seen $1 trillion of individual investor money get pulled out of the stock market since 2009. So individual investors still hate the stock market, still hate it. They're sitting in cash and sitting in bonds. They have not embraced the market. So I don't know, this is a question, who the hell is answering this survey, right? Because we can see the numbers, we see the flows. The money's not going in, the money's flowing out, has been since 2009, pretty consistently. So I don't know why, if they're bullish, why aren't they investing? It's a good question, I don't know. Okay. So, the 10-year Treasury started the year at 2.45. Everyone said it was going to go up from there. It ended the year at 2.4. So the 10-year Treasury actually dropped a little bit. I think that's it, though. I've said that many times, but I think that's it. Right now, it's sitting at 2.7. So I think that the 30-some-year bull market in bonds is over. We've been prepared for that for a number of years. We've been short duration, we've been non-US denominated bonds for a number of years. So that's not a surprise. We're thinking that maybe by the end of this year, we'll see a 3%. So why does this matter? So you've probably heard or probably read about the yield curve as the predictor of recessions, right? So it's not 100%, but it's the best predictor of a coming recession, the yield curve. What that means is, if you think about a 6-month, a 1-year, a 2-year, a 5-year, a 10-year, a 20-year, a 30-year Treasury bond, that the yield on the 2-year or the 6 months should be really low relative to the yield on the 10-year or the 30-year, right? The yield on the 30-year, you take more risk, more volatility, so you should expect a higher return from that risk. Make sense? Okay, so an inverted yield curve is when the front end goes higher. So what would make that happen? If the Fed raises rates, and it doesn't affect the long end stays low. The Fed might stop raising rates. The market might call bullshit on that. We don't know what the market will do. But the fear is that they're going to raise rates because they have to, and the long end won't respond. So that's what the talk is. That's the talk. I don't think that's reality. I think we'll actually see the long end respond. And we're already seeing it. We haven't seen it for a long time, but it's now in the last month gone from 2.4 to 2.7. That's a massive jump. That's a big jump. Even though it's a small percentage, it's a big jump. That's the beginning of longer term. Okay. So we talked about normalizing policy, about money coming in versus money going out. In the US, there's two different ways we've done this. There's quantitative easing, right? There's interest rate reduction. So we've printed money and purchased bonds, and then there's reducing rates, okay? So in the US, we are reversing course on both of those things. And if you read the letter, you know that we've gone from ludicrously, what's the word? Loose monetary policy to ridiculously loose monetary policy. And by the end of this year, we'll be very loose monetary policy. It's still crazy loose monetary policy, okay? In the European Union, they're reducing their bond purchases. They're still buying bonds in the open market, but they're reducing it from 60 billion a month to 30 billion a month. And by the end of the year, we anticipate that'll be zero. And then they too will start retracting money out. Japan has other issues. We don't think that that's probably done because they've got a much longer term problems there. So does that answer the question? So globally, we're switching from stimulative to destimulative, but we got a long ways to go before that happens. So we know about this. We're increasing short-term rates, reducing the balance sheet, and this one, we are shortening the maturity. We sell a bond that's a 3-month maturity, and we buy a bond that's a 10-year maturity. And by doing that, in 3 months, when that maturity comes due, when it matures, we don't reinitiate that. We don't sell another bond. So that's another way of reducing the balance sheet.